The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the second Investor Education webinar hosted by the Trinidad and Tobago Securities and Exchange Commission. Before we start, I would like to state that we are not here to tell you where you should invest or how to make more money. We are here to ensure that you have the information you need in order to make sound investment decisions and that you have a better understanding of short and long-term investments. We have a poll question for you. Have you ever heard of the TTSEC prior to finding out about this webinar? The Trinidad and Tobago Securities and Exchange Commission, or TTSEC, is the sole regulator of the nation's capital market. This includes the market for stocks, bonds, and mutual funds. Our fellow regulator in the financial services sector is the Central Bank of Trinidad and Tobago, which regulates the banking and insurance sectors. Both entities report to the Minister of Finance. As of April 2014, the value of the securities market was $296.02 billion TT dollars. This represents 169% of gross domestic product. The Trinidad and Tobago Securities and Exchange Commission is the regulatory body mandated to look after the interests of investors in Trinidad and Tobago. We administer the Securities Act 2012 to protect you by registering all persons who deal in securities. Check the list of registrants on our website www.ttsec.org.tt before engaging in any securities transactions. Ensuring that all of the information about the security that an investor would need in order to make an informed decision is disclosed by the market participant, both to the Commission and to potential investors. We conduct routine market surveillance and investigate possible breaches of the Act, as well as customer complaints against any person conducting securities business, whether registered or not. Ensuring that registrants are operating in compliance with the legislation and conducting on-site inspections of registrants and self-regulatory organizations. The Commission enforces rules through the use of orders and compliance directions, as well as through the issuance of guidance via circular letters. We also conduct a multimedia investor education program designed to provide investors and potential investors with suitable information to guide informed decisions. Our investor education program is guided by the International Organization of Securities Commissions, IOSCO, of which the TTSEC is a member, and was elected as a representative on the Inter-American Regional Committee, IARC. IOSCO has long recognized investor education as a key strategy for enhancing investor protection, promoting investor confidence, and fostering investor engagement in financial planning and decision-making. Our investor education program is also guided by our legislation, the Securities Act, or SA 2012, which identifies to educate and promote an understanding by the public of the securities industry and the benefits, risks, and liabilities associated with investing in securities as a key function of the TTSEC. Two topics that we always hear about when dealing with our financial well-being are savings and investing. But what's the difference? Savings can be best explained as money that is put away regularly to pay for expensive items, for example, a holiday, furniture, or a special occasion. Savings can be short or long-term and generally attract a minimal rate of return. Money earns interest, usually quarterly or yearly, with little risk. The risk is usually based on changes in interest rates, and the money can be retrieved immediately or after the requisite notification period. One example of a short-term savings option is a fixed deposit account that provides the account holder with a fixed rate of return. In return, the holder agrees not to withdraw or access his or her funds for a fixed period of time. In a fixed deposit account, interest is only paid at the very end of the period. This is unlike regular savings accounts, where interest is calculated daily and typically paid to your account at the end of each month. Because the term and interest rate are fixed, you can very easily calculate the amount of interest you will earn at the end of the period. It is important to note that all bank deposits are insured by the Deposit Insurance Corporation of Trinidad and Tobago for up to $125,000. Please note that the responsibility for supervising banks rests with the Central Bank of Trinidad and Tobago. This is not the remit of the TTSEC. Investments can be short-term, under 5 years, but are generally for 5 years and over. With investments, the money is invested in assets whose value can rise or fall. The greater the opportunity to get high returns, the greater the risk, and there is no guarantee that you will get an increased return or even recover your original investment. We now have a poll question. Do you consider yourself to be an investor? Now, let's discuss the basic steps in investing. The first step towards you will make better decisions about your money if you develop and follow a plan for investing. Ask yourself these questions and write down your responses. What are my top financial goals? When do I hope to reach these goals? How much money do I need to attain these goals? Step 2. Find out what type of investor you are. Investing is about choices. Your investor profile is determined by the choices that you make. You can determine your profile by answering these 4 questions. 1. How do I want to approach investing? 2. How important is it for me to keep my money safe? 3. How comfortable am I with risk? 4. How important is it to me to make a good return on my investments? Step 3. Determine your investment objectives. It is safe to say that most investors have 3 broad objectives. They want investments that are safe, generate attractive returns, and are easy to access in case of emergency. Unfortunately, you don't often get all of these wrapped up in one perfect investment package. Step 4. There are a wide variety of investment options from which to choose. Your choice depends on the amount you have to invest, your investment goals, the time frame within which you expect your return, and the level of risk that you're willing to take. I have mentioned the word risk more than once in this presentation, but what does risk mean? Simply put, risk is the degree of uncertainty about the return an investor would earn on an investment. In effect, this means that there is a possibility of an investor incurring a loss on his or her investments. Remember, the higher the return, the higher the risk. That higher return is your compensation for taking on the additional risk. Before you start investing, you must determine whether you consider yourself to be a risk taker or not. That risk profile determination will guide you regarding the types of investment instruments best suited to you. Poll question. Do you consider yourself to be a risk taker or are you risk averse? Before we proceed, I need to ask, do you fully understand what we mean when we use the term security? A security is an investment instrument that has a value and can be traded. Some examples of securities include treasury bills, stocks and shares, bonds, and mutual funds. Securities can be short-term or long-term. How do we define short-term? These refer to investment products that you maintain for a maximum of about 3 to 5 years. Treasury bills are managed by the Central Bank of Trinidad and Tobago. They are short-term, government-issued debt instruments used to raise money from the public. In Trinidad and Tobago, any individual or company can purchase treasury bills, which are issued for periods of 3 months or 6 months. Treasury bills are issued through a bidding process at auction. They are traded, bought and sold, on a discount basis. This means that the price that you pay is equal to the face value less the amount of the discount. When they mature, the government pays the holder the full par or face value. Effectively, your interest is the difference between the discounted purchase price of the security and what you get at maturity. One reason that T-bills are popular is that they are one of the few instruments that are affordable to individual investors, since the minimum denomination is $1,000 and the bills increase in multiples of $1,000 thereafter. More information on Treasury bills is available at the Central Bank of Trinidad and Tobago's website. We will now discuss long-term investment products. Do you remember we previously mentioned the term securities? Not only are these investment instruments that have a value and can be traded, but they also entitle the owner to specific financial benefits. The main classes of securities registered with the TTSEC are equities such as stocks and shares, debt instruments such as bonds, and mutual funds. Equity refers to an investment instrument through which a corporation raises capital by issuing shares. Stocks, as they are also more popularly known, are shares of the ownership of a company. Initially, they are sold by the original owners of a company to gain additional funds to help the company grow. After the initial sale, the shares can be sold and resold on the stock market. Apart from gaining an ownership interest in a corporation, shareholders are also entitled to a share in the corporation's assets and profits. When a corporation earns a profit or surplus, it can either reinvest it in the business, it can distribute it to shareholders, or it could retain a portion of its earnings and pay the remainder as a dividend. Being a shareholder in a company gives you benefits in the form of dividends based on the stock's performance in a financial year. A dividend is allocated as a fixed amount per share, with shareholders receiving a dividend in proportion to their shareholding. Owners or shareholders can also receive capital gains based on the upward movement of a stock's share value. A capital gain is a profit that results from the sale of a capital asset, such as stocks, bonds, or even real estate, where the amount realized on the sale exceeds the purchase price. The gain is the difference between a higher selling price and a lower purchase price. Conversely, a capital loss arises if the proceeds from the sale of a capital asset are less than the original purchase price. A capital gain or loss is only realized when the asset is actually sold. This chart shows the performance of a security over a period of 7 years and highlights the volatile nature of the market. If an investor purchased shares in this security at the start of January 2008 at $80 per share, he would have experienced a capital gain for the greater part of that year until the price began to steadily decline nearing the end of 2008. The price leveled for much of 2009 and began once more a steady decline until late 2010. After which there was a recovery at the end of 2012, with the price per share appreciating to $110. Following a temporary dip in the share's price, there was a somewhat continuous appreciation of its value to $121 as at the close of trading on June 30th, 2014. Once more, price volatility is seen over the long term, and in some cases an investor may choose to keep his or her investment during this time, await a recovery and sell when the price peaks, or he or she may choose to bail out and count the losses. If the investor chose to keep his or her shares for the entire period shown in this chart, there would have been a net capital gain of approximately $41 per share, representing a very healthy return in 7 years. The story would have been different had he or she chosen to bail out sometime at the end of 2011, since there would have been a loss of approximately $15 per share. To simplify it further, here's another example to explain capital gains. Let's say you bought stock X in 2008 for $40 per share. Despite the ups and downs of the market, the stock price in 2014 has risen to $85 per share. This means if you had bought 1,000 shares in 2008, you would have spent $40,000 to obtain those shares. In 2014, those same shares would have appreciated in value and are now worth $85,000. Therefore, if you were to sell your shares at this point, you would have made a capital gain or profit of $45,000. You can also decide to continue to hold the shares in the hopes that the value will continue to appreciate even further. We come now to debt instruments or bonds. These are essentially a loan arrangement between the issuer of the bonds, a borrower, and the purchaser of the bonds, an investor or a lender. To show how this works, let's use this example. If the government wanted to build a new port, it could issue a bond, that is, raise funds, borrow, from institutional investors such as banks and other financial institutions, as well as the general public, who are the lenders. For this, the lenders will receive a set rate of interest on the sum loaned. During the period between when the bond is issued and when it matures, the investor receives a periodic interest payment known as a coupon payment. When the duration of the bond comes to an end, it is called the bond's maturity date. On that date, the company or government that borrowed your money is supposed to pay it back in full. This amount is called the face value of the bond. At the end of the repayment period, the lenders will have gotten back their principal as well as the interest. Bonds are usually long-term in nature and can go for up to 30 years. Some investors sell their bonds before they reach their maturity date. However, you can lose money by doing this since you forego some of the interest payments you would have gotten if you kept the bond to maturity. So what are the advantages of purchasing bonds? They provide a steady flow of income from interest payments. You usually get your money back if you hold a bond until it matures. Bonds are a more conservative asset class than equities, and so you can lower your risk by having some of your money invested in bonds. They can help pay for future long-term goals, for example, university education, purchasing a house, or even providing retirement income. However, because they present less risk, they also have less potential for growth than stocks. A mutual fund is a type of professionally managed collective investment scheme that pools money from many investors to purchase securities. Such funds often offer a broader range of investments than you can purchase individually. The types of securities that a particular fund may invest in are identified in the fund's prospectus, which is a formal legal document required by and filed with the Securities and Exchange Commission. It provides details about an investment offering for sale to the public and should contain the facts that an investor needs to make an informed investment decision. A mutual fund prospectus usually contains details on the fund's investment objective. This is the type of income that the fund seeks. For example, a capital appreciation fund generally looks to earn most of its returns from increases in the prices of the securities it holds, rather than from dividend or interest income. The fund's investment strategies. This is the criteria that the fund manager uses to select investments for the fund. It should also include information on risks, performance, distribution policy, fees and expenses, and fund management. So how do mutual funds work? Investors buy shares or units in the fund. Their money is then pooled and used to purchase various securities. A fund manager is assigned to manage the fund on behalf of all of the investors and decides where to invest the money. The manager also decides when to buy and sell investments for the mutual fund. Most mutual funds are open-ended, meaning stockholders can buy or sell shares of the fund at any time by redeeming them from the fund itself rather than on an exchange. A closed-end fund is a publicly traded investment company that raises a fixed amount of capital through an initial public offering or IPO. The fund is then structured, listed, and traded like a stock on a stock exchange. It is important that you sit with a registered investment advisor to choose a fund that selects the kinds of investments that suit your risk appetite and that will help you meet your investment goals. You may well ask the question, how do I make money from a mutual fund? Well, the mutual fund is managed by a professional investment manager who will work diligently to make sure the fund performs well and so buys and sells securities for the most effective growth of the fund. As a mutual fund investor, you become a shareholder of the mutual fund company. When there are profits, you will earn dividends. When there are losses, your shares will decrease in value. Mutual funds are by definition diversified, meaning they are made up of a lot of different investments. That tends to lower your risk. Remember, control the level of risk by choosing funds that invest in safer, more stable investments. Talk to a registered advisor to help you make choices that fit with your financial goals and tolerance for risk. Poll question. What type of investment products do you have? Here are some tips to help you become a better investor. Monitor your portfolio. Ensure that your advisor is registered with the Commission. Once the advisor is hired, monitor that he or she is following your investment instructions. Monitor the performance of your portfolio by reading your statements and paying attention to any news articles about the companies whose stocks you have bought. Keep good records of your investments so that you will know how well each one does. Start an emergency fund so you won't be tempted to dip into your investment funds in difficult times. Patience is a virtue. If something sounds too good to be true, it usually is. The power of compounding interest takes time to often, and accept that the road to riches is often long and slow. Remember, the sooner you get started, the better your chances of achieving your goals. Always remember what your grandmother used to say. Don't put all your eggs in one basket. Keep your portfolio diversified with a mixture of investments with varied risk. That way, if one or more does not perform as expected, all is not lost. In order to purchase stocks on the stock exchange, you must do so through a broker. Here is a list of the 7 registered brokerage houses with which you may opt to do securities-related business. Before making any investment decision, you should undertake these steps. Obtain written documents detailing the nature of the investment. Read and understand those documents. Verify the legitimacy of the investment. Deal only with registered financial institutions and intermediaries. Find out your options if something goes wrong. After you invest, ensure that you keep files with all of the information in statements and notify your investment company of any discrepancy. Pay attention to public announcements regarding mergers, tender offers, or other actions by third parties. Get professional advice before you agree to exchange or sell your shares. On behalf of the Trinidad and Tobago Securities and Exchange Commission, thank you for participating in our second Investor Education webinar. We look forward to your participation in our third webinar, where we will focus on scams and ways to safeguard yourself against these fraudulent schemes. Remember to check our website and Facebook page for information about investing in the securities market. You can also request a free investor education session for your school, workplace, or NGO through the form located on our website. Let us know of additional topics that you may be interested in learning about. You can send your comments and suggestions to ccei@ttsec.org.tt. I hope you have a productive day and happy investing.